Could you all go ahead and please mute your computer? Mute. Thank you. It's 2:30, so I'm going to go ahead and start. This is the January 14th, 2021 meeting of the Knox County Investment Committee in accordance with Tennessee Governor Billy's Executive Order number 51 regarding COVID-19. This meeting is being held electronically. Remind everybody to please mute your computer if you're not speaking. And all votes, I believe, do have to be taken with a roll call vote. And even though it's not on the agenda, Ms. McGinnis, would you mind going ahead and taking roll call for the meeting, please?
Okay, Mayor Glenn Jacobs.
Here.
Ed Schaus.
Here.
Chris Caldwell.
Here.
Larson J.
Here.
Okay, Kyle Ward is not here. And Mike McMillan.
Here.
Okay, we do have a quorum.
Thank you. The next order of business is to approve the minutes from the October 2020 meeting. Are there any corrections or discussion that need to occur?
Motion to approve.
Second. Okay, motion approved by Mr. McMillan, second by Larson J. Ms. McGinnis, would you please take a vote on this?
Okay, and Mayor Glenn Jacobs.
Yes.
Okay, Ed Schaus.
Yes.
Chris Caldwell.
Aye.
Okay, Larson J.
Yes.
And Kyle Ward is a no. And Mike McMillan.
Yes.
Okay, motion's approved.
Thank you. And just for your all's information, I may have to leave the meeting at about 3:45, in which case Mr. Caldwell will take over. The next item on the agenda is approval of the investment of estimated spend down proceeds of Series 2020C bonds by Mr. Caldwell.
Thanks, Mayor. This is really simple. We went to the market for bonds a few months ago, and according to our external auditors, we have to approve a spend down schedule once this happens. And so you would see in your packet a spend down schedule beginning December of 2020 through November of 2022, just spending down those proceeds as to when those would be drawn down. And Ed and I have already signed off and approved, but it's got to be approved by this body as well.
Are there any questions from Mr. Caldwell? Hearing none, we need a motion to approve.
Motion to approve.
Second.
Motion to approve by Commissioner Jay, second by Trustee Schaus. Ms. McGinnis, you please take the vote.
And Mayor Glenn Jacobs,
Yes.
and Ed Schaus,
Aye.
Chris Caldwell,
Aye.
Larson J,
Aye.
and Kyle Ward is no, and Mike McMillan.
Aye.
The motion's approved.
Okay, thank you. Mr. Schaus, the trustees report.
All right. Thank you, Mayor. We've had a good quarter, and that obviously receipts have been, this is our busy season, of course. People start paying their taxes in October. I'll pick up where we left off there at the October meeting, which we had, September was a report there. October receipts were up about $1,000,007, 32.4 million to 34 million. November, almost dead even, 17 million each. I'm comparing using my 20 numbers comparing to 19. We were down about 50,000 for 17 million forward, 17 million 5 in November of 19. December is one of our biggest months. Of course, February is our biggest. In December, we get a $50+ million wire transfer from it's a group called CoreLogic. They collect their consolidators of banks all over the country, maybe all over North America that hold mortgages in Knox County. We got like a $54 million payment from them. Total receipts, property tax for December, 97,400,000 compared to 96,619. So we're up about 800,000 there. Of course, with the bond market being what it is, and as we speak, still getting 100 basis points or 1% across the street at BB&T. We did not make any purchases through Raymond James, through Steve Rosen. I guess we would have been in the mid to high teens, and Steve will address that later, I'm sure. No purchases there. We still have about $1.3 million at LGIP. As we speak, they're paying 25 basis points. I think next on the agenda, I have it on my report here, but I guess I'll wait for the mayor to move us on. Pearl and other members of staff, Ben Sharple and Chris Caldwell's people have worked diligently on the new bank contract. I don't want to get ahead of myself, but my report, that's about the extent of my report. The portfolio with Raymond James is roughly slightly under 11 million. Love to start buying some stuff from Steve again. I know he'd like to start selling some, but at 15 to 20 basis points, it's that's below what we can pick up, obviously at BB&T, and probably below what we expect to pick up from our new banking partner, who we'll touch on that in a minute. Balances have been very strong. I mean, we're well north of 100 million, 130 million when we get these surges in from places like CoreLogic and, of course, our sales tax and BEP money. So this is a great time for us to be happy about our balances. But that's about it for the trustees report, Mayor. Thank you for taking any questions if anybody has any.
Thank you, Mr. Schaus. Are there any questions? Okay. Thank you, sir.
Thank you.
And next is update on status of recommendation for the banking contract by Mr. Schaus and Pearl Mathis, please.
I hope Pearl's with us here. I don't see her up there. She's probably, if I hit the arrow. Lots and lots of time was spent by Pearl in association and coordination with people from Chris's office and from Ben Sharple. Of course, those guys were the drivers of this. And I don't know how many hours they spent on it, and many, many more are going to have to be spent going forward. The bidders were, I guess I touched on it. I don't recall exactly. I don't think I did touch on this 3 months ago. First Horizon, or formerly known as First Tennessee, Truist, who we have currently, BB&T / SunTrust, and First Bank, as in formerly Clayton, year and a half or so back, Clayton. They were the three banks who put bids in for our portfolio, if you will, or our funds, and all the myriad of other dozens, really hundreds of things that we need banking services for. And after many hours of work, the banking committee recommended First Bank. The competing bids were, well, basically extremely low. The yield on our funds was extremely low, as in the 1 basis point area. First Bank, the bid basically is a floor of 50 basis points, which is really, in today's market, I feel competitive. I hate to use this expression, but I think it's an above market rate. And there are several variables to it, as there are with the BB&T situation. Market goes way up, or we will ride it up. Market goes way down. We've got this floor of 50. Of course, if the phenomenon happens which has happened internationally, I don't know that it's happened in the U.S., happened 7 or 8 years ago, but rates going negative, which is a possibility. Steve may correct me later. I think you Google the negative rates internationally, bonds and so forth. There's still $15 trillion sloshing around the world economy in negative rates. So that is a possibility. But as we stand today, which we will start transferring the bulk of our funds to First Bank. I believe that may come into effect. If Pearl wants to address it, she certainly is welcome to. In the next month or so, 50 basis points is what we'll earn. Now, of course, this will go to commission, I think, I guess in January. And I'll be down there to answer questions if I'm asked, and if I can offer any perspective or answer questions. But 50 compared, if you just look at what you earn on if you have a money market, just look what you're earning on it right now. You're getting 3, if you're very fortunate, maybe keep huge balances or make your money some other way, make money off you some other way, you might get 8 or 10 basis points. I mean, you may get 15, but it's hard to find that. You can look at these online people like, I think Goldman Sachs' thing is called Marcus, Ally Bank, 1 or 2 others. They're in the 42 to maybe 51, 52 basis points. The best I've seen around town on money market funds is around 30 to 32 basis points. So 50 is, I feel, very competitive. It's extremely competitive, and it's above market, frankly, in my opinion. The negative is 50 is not 100. 100 is what we have been getting for 5 or 6 years. So we're cut in half on that, but realistically, we could have been cut to 10 basis points. And again, I'll try to be prepared to address that if I'm asked whenever this goes to commission.
House, I got a quick question.
Yes, sir, Lauren.
2 quick questions. One, does being a newer banking institution, First Bank, than the others that have bid, is there any concern that they don't have the same structural capabilities or service or online portal? I mean, is there anything that they don't do that the others offer from a sort of operational standpoint, or is it all pretty level?
The people being Ben Sharple and his staff said they felt more than comfortable with, they researched First Bank and their operations in Middle Tennessee and West Tennessee and elsewhere. And they're a lot bigger guys than they appear to be in Knoxville. That's, I guess, capital wise and credit wise, asset wise, and things like that. And operationally, I didn't hear anything negative. I was not on the committee. Pearl was on it from our office, but I don't think there'll be issues there. And
Pearl, anything that came up during that is when it was talking about operations?
No, there was no negatives on the operational part of it. Matter of fact, they were very competitive and their pricing for the services were much lower than the two other bidders and doing the same service. So it wasn't any for structural, technical, all the technology, everything is in place there. Matter of fact, on January the 12th, Jeff and I had a Zoom meeting with 3 of their staff, start going over their implementation checklist. So we are starting to give them information and they're on it right away because as Mr. Schaus was saying, February the 1st, we will go with the account, concentration account, transferring a bulk of the funds into that account in order to earn that 50 basis point. Because at the end of January, the one that we're getting from BB&T at this time will end. That rate will. So there's not been a problem as far as structural or technical.
Okay. The other question I have is just about timing. I see on the commission agenda this month, you're asking for a contract amendment with BB&T Truist extending through June 30th. So tell me the timing of when this First Bank would begin, or is there a bit of an overlap and you need that next sort of 6 months to transition things between the two entities? Is that what the extension's for?
Yes, it is. The overlap is for that purpose because of the nature of all the accounts we have and what needs to be transferred.
Okay, so you'll start working on that this month, but over the next 6 months, it'll be completely done by June 30.
Yes.
Okay, thank you very much.
And I feel, just as one last editorial comment, I guess, like you look back 15 years ago, 10 years ago, I came into this office 6 years ago, or 6 and a third. We still had 3 or 4 people getting a payroll check, an actual physical check. We don't anymore. I don't know if the county still does that anymore or not, but you're looking back 10 years ago, you needed somebody with 30 branches around Knox County or around East Tennessee, so people could pick up their check on Friday and go out there and cash it or put it in the bank. And those days are past. So I just mentioned that because obviously First Bank doesn't have 30 branches around like First Horizon or Truist or Home Federal, some of the other people that we know and are friends with and use. So that's not an issue anymore. I think they have 4 branches. I think they're looking at one in Fountain City. So anyway, that's probably the branch side of banking is not the factor that it once was.
Is there any last question? Sorry to.
Oh, sure. I'm sorry. Yeah.
Is there any reason we only got 3? There's a lot of banking institutions here. Is there any reason we got 3 that put a bid in? Is it too complicated, too big? It seems like Knox, with the amount of money that Knox County manages, we would be quite the get. But it was surprising to hear only 3 took a shot at it.
Ben might be able to address that.
I'll chime in on that. Can you hear me, Ed? I'm having
a terrible
problem.
Yeah, sure. Yeah.
Okay. Larson, I'll chime in on that. I was shocked you got 3 responses. I mean, it's the capital requirements, the earnings opportunities, the collateral requirements. It's just unattractive business for banks right now. So my 2 cents is if you all got 50 basis points, that's absolutely amazing. And it's probably 55 basis points over market.
Thanks for the clarification. Appreciate it.
We did hear one. They're friends of mine, so I won't say who they are, but we did hear the comment in this process. Well, you're great guys over there at Knox County, but we don't need your money. So
And that's not a negative or a slur. It's just
Right.
deposits are a problem right now. They're not a solution. Everybody can take deposits if they want them. It's what you do with the money once you got it. It's the problem.
Mr. Schaus or Mr. Caldwell, what is the fiscal impact of losing 50 basis points on our overall revenue? How much do we collect a year off of that or have in the past?
Probably got that.
The neighborhood of about $1 million, I think, Ed. So it's going to be cut in half. Is that correct?
It's basically going from, I thought I had it right in front. It's an impact of probably $500,000 to $600,000. Historically, maybe a little bit more going back because before interest got as low as it is.
Sure. Yeah, but I think last year was a little over $1 million that we.
Okay, yeah, we'd be looking at
about 500,000.
cutting that in half.
Yeah. Okay.
Cutting that in half. Yeah.
Okay. Are there any other questions? Okay. Thank you, sir.
Thank you.
Moving on.
Hey, Mayor, I think we got to vote on this. So I'll make a motion to approve.
Oh, this is an update on status, a recommendation. So
Was this supposed to be voted on? Ed? I can't remember.
I don't.
It's on our agenda commission to vote on, I think,
Yeah.
in 2 parts this month. So.
Yeah, on my agenda, it's just updated on status of recommendation for RFP bank contract.
That's
So
my mistake.
do we need to have a vote that we
I
are
don't
recommending this?
I think we're okay.
Okay. Okay, then moving on to Mr. Rosen and the review of investment portfolio. Show is yours, sir.
Well, the first thing I would do is fire me for any technological consulting because I am having a total meltdown over here. And the irony is we spent so much money on this system that the office operations person wouldn't tell me how much we spent, except I'm the first one to use it. So I'm learning as I go here. And I think I'm clicking on share the screen, and I hope this works. And let's see if this works. Oh, do you all see that? You do? Thank you. Can you all hear me okay? Okay, thank you.
Yes, sir.
All right, so I'm going to try to do this now that I'm not as flustered as I was 30 seconds ago. But the key assumptions we're going to deal with are closures, virus. It's a supply issue. The idea of lower for longer lives. We're floating on a sea of liquidity, and politics ain't what it used to be. So let's see if I do this right. Oops, maybe I don't do this right. And I go to here. Okay, you all still with me? Somebody let me know I'm alive.
You are
Thumbs up.
Looking
Okay.
at this.
All right, thank you. Okay, so you all see COVID by the numbers?
No, we're still on the first slide.
It's showing Knox County Investment Committee, the cover page.
Let's see if this works. Want to say, don't say. How about this? Oh, okay. Now I got to go back. I'm learning. I'm slow, but okay. How about this one?
Yes.
There you go.
Miserable slide. Thank you very much, and thank you for your patience. Okay, so I'm not going to spend a whole lot of time on this, but depending on how you have your pictures oriented, this is just miserable, and you can see the spike up in numbers. So what I want to just because we could spend hours on this topic alone. But what I want to impress you with is that starting on the 20th, the conversation is going to flip. And right or wrong, it doesn't matter, but it's reality. We're going to go from a mentality at the national level where closures are the problem, don't blame me for the virus, to the virus is the problem, don't blame me for the closures. So everything you hear on a daily basis is going to have kind of a different approach to it. And we're going to have to deal with that. We're going to have to understand it as policymakers and as market participants, that everything we hear is going to be a different tone than it was before. The facts won't necessarily change, but the approach will. So you all see me scrolling? You can see where I'm onto a chart now. Am I doing that right? Okay, thank you.
Yes.
Okay, so interest rates have come up just a touch, but not much. As you can see where we were back when we met last, back in October, the 3-year Treasury was around 15. The 2-year Treasury was around 12. We haven't moved much. I mean, we've gotten the 3-year Treasury up, this morning to 21, and the 2-year Treasury to 14. So we've made a little bit of progress in rates, but not much. So as a reflection of what Ed was talking about, earning 50 basis points for doing nothing is a tremendous achievement. Are we going to be here forever? Yeah. This isn't changing. This is a chart of the Fed funds futures contract. You got to look at it backwards. 100 minus this number right here is where Fed funds is. So if the contract up here in the left-hand corner, when I printed this, was 99.9125, that means Fed funds were 0.0875. Well, this chart shows you that the expectations of rates rising is not much. Look, this is a November of 2022. We're thinking the market says we're only going to get to 15 basis points in Fed funds. That's all the way out to 2025. I mean, we're projecting rates to be like they were from 2008 to 2015, just flat as a pancake, not constructive for investors. How could this possibly happen with all the debt that we're putting out? Well, as you know, we've run the greatest deficit in our history in 2020 with all the relief programs, the lack of tax collections, et cetera. We've grown the debt $4 trillion in 2020. So we went from this point right here to here in debt, $27 trillion just in a year. We may add on that much again this year and get up into this territory. But while we're doing this, look what the Fed is doing. The Fed, and you want to look at this axis over here, is taking their balance sheet from 4 trillion up to 7 trillion. So we're at 7.3 trillion on Fed assets just in the last year. So the Fed has bought back basically 75% of what the Treasury growth in debt is. So that's why we're keeping it under control and rates are as low as they are. It looks like this program is going to continue. There was a little talk about a Fed taper, if you remember the term from, I guess, 7 years ago, the taper tantrum. That isn't happening. You had several Fed governors out this week saying, including Powell, saying we're not doing anything till we see inflation, and we want to see a lot of inflation to make up what we haven't done. So what's the stock market doing? This chart right here is the S&P 500, but it's equal weighted. So instead of giving Amazon the gargantuan market cap it has, or Apple or Google or some of the others, Microsoft, it evens it out so that any stock, the smallest stock in the S&P is weighted the same in this chart as the largest. So here we had where the market was last year. We were at an all-time high. Then we get the famous notification in February from Nancy Messonnier that the world is falling apart because of COVID. Market plunges down here. Whoops, Sorry about the editorial from my sister from New York. You'll just have to ignore that in the left-hand corner or the right-hand corner. We bottom out down here in March, and then we start to take off. The Fed comes to the rescue. Then we get fiscal stimulus in. Then the market flattens out here when we get the second wave of the virus. What happened right here? Well, hard for everybody to unmute. The virus, the vaccine. It works. Oh my God, it works. The market shoots up on the vaccine hope, all the way up to where we are here today. So how is that possible? Well, remember my line about stocks. Stocks are built on lies. Liquidity, interest rates, earnings, and sentiment. Well, the earnings, the market's kind of the stocks are giving the economy a mulligan on the earnings, but sentiment, liquidity, interest rates, it's all in the favor, and that's why we're running up to new highs. The winner, the hero in this area has been the Russell 2000. What the Russell 2000 is, if you pick the 3,000 largest companies in the United States and forget the first 999 and just take company 2001 down to 3,000, that's what this chart looks at. And it is just outrageous. 28% gain since early November. It's really higher than that. I don't know why I picked this date right here, but it's more than that. And this is the real economy companies. This is not just the heavily weighted in tech. This is everything. And it's been the star this year as the Russell 2000. So what's the economy doing? We know the stock market we don't want to rely on. What's the economy doing? Well, as I've said in previous meetings, I'm not real crazy about surveys right now because that's a how you feeling today kind of response. And it's a point in time when that professional fills out the survey or that person takes the call on the phone at dinner time. But this one tells a story. This is a Purchasing Managers Index. ISM is the Institute of Supply Managers. If you looked at this stuff for a while, it used to be years ago known as the National Association of Purchasing Managers. They changed their name. It's now the Institute of Supply Managers. This is their services industries index. And the reason I picked this one is because services make up really the bulk of our economy. It's 2/3. So here's the interesting part. The overall index plunged, right? You see it going down, but then it comes up and it's up to 57.2. And this is a 50 over underline. So 50 over 50 is good. Down here at 30 is a disaster. So sounds good, right? 57. Good survey. Things are going well. They're improving. People feel better. Here's one of the problems. One of the key inputs is supplier delivery. So think about that. You order something on Amazon. They tell you, well, it's back ordered. You're not going to get it. Well, you think in the back of your mind, well, that's because everybody's trying to buy it and they're running out, and it's a good product and it's a good, you know, I'll eventually get it. I won't be the first one on my block, but I'll be the third one. So normally when supplier delivery are slow, that's a good thing. Here's the problem. It's not a good thing. We got a mess in the economy right now. Supplier deliveries are slow. This metric is up to 62.8, which sounds good, but it's because we've got supply line disasters all over the place. And we'll see that show up in other indicators as we go along through this. So look at the employment number, totally rolled over and fell below 50. It's at 48.2. So the survey sounds good on the surface, but when you look at employment and you look at supplier delays, not a good situation. Labor force. We've gotten the unemployment rate down, right? And just think about this chart. Remember, it's a check mark. A lot of our charts are check marks. They're not super Vs, they're check marks. Well, here's the problem. The labor force hasn't recovered. We're only running 61.5% of our population is in the labor force, down from 63 and change up here. We're not putting people back to work. This is a real problem, and it's not going away. Now, we have issues going on with that. You know, you've got job dislocations, you've got closures, you've got industries that aren't even existing right now. I mean, think about Gay Street. You can walk down the street and you'll pass a Tennessee Theater and Regal Cinemas. Those are closed industries. Those people are out of work. It's not their fault. It's not that they've got employment benefits. They don't want to go back to work because they're making more money at home. If they're sick or they're healthy, they can't go back to work. The opportunity's not there. That's a problem. The broadest measure of unemployment, U6, we are still running a stage right down here in the 12% area. This is a bad situation. We have not fully recovered. We're nowhere near where we were before the pandemic. We're back here in where we were when we were still coming out of the recession. But retail sales are good, right? Well, they're good online. How many of you are like me? You go to the mailbox when you get home and the mail's not there. It's because the mailman hadn't gotten to the mail yet. And then somebody in the house says, I don't care about the mail, but I'm expecting a package. So you got to go look what door that package got left at. Look at online sales, skyrocketing. Tennessee, brilliant. Figured out how to tax this stuff. Mr. Caldwell is trying to keep from smiling. It's a tough formula not to smile about taxes on online sales. It's kept us going. But are we really buying enough? Not really. Look at the savings rate. Savings rate is 13%. We're a consumption-driven economy. We're not an investment-driven economy. We're not out building ships. We're buying things. We're keeping each other employed because we spend our money. I think the last time that we spoke, I had a chart on the velocity of money. We've pushed all this money out into the system, but it's not being spent, it's being saved. And you heard conversations about stimulus checks. If you give someone who is unemployed $600, it's going to get spent on food, clothing, and shelter. If you give someone who's had a job, hasn't had any dislocations, and has done all right, it's probably going to get saved, or it's going to go into debt reduction. That's what we're doing. Look where our savings rate was just a few years ago. Even during the crisis, we didn't spike much. We only got to less 7%. Here, we haven't gotten back in the spend mode. That's not a level of confidence. It's also a case where the people that have the money aren't necessarily spending it because they're locked at home. My mother is a world traveler. She's probably been in 100 countries, depending on what country took over what country or who's got independence now. I asked her the other day what she's doing for exercise. She said, I'm climbing the walls. So that's somebody that's not spending money on travel. But we are spending money on homes. And the last time we got together, home building was up here. Single family home sales were up here running strong. And I don't know if it's still the case, but you employ somewhere around 5 people for every home under construction. Look what we've done in the last couple of months. Even with interest rates, mortgage rates at all-time lows and still hitting lows, we're rolling over on the home industry. Now, it's not where it was back here. It's still strong, but it's not the economic driver it was in 2020. We'll see what happens. Again, you got supply line issues, and then how many homes are people going to buy? I like this indicator, and I just started looking at it in the last 6 months or so. Again, this is more of a V, right, from where the pandemic was to where we are now. But look, it's rolling over too. This is gasoline usage. This is a hard fact number. We're running about 8 to 10% below where we were comparable weeks pre-pandemic. I love this term, before times. That's before we all had the virus. And this is a weakening trend. You see the trend is not good on gasoline usage. Where are you going to go?
I have a question on that slide. Is a little bit, even though the levels are lower than the last, say, same period in 2019, the decline seems to be, the winter months, December, January. There seems to be even though the whole level is lower, certainly some of that's behavioral of just everybody's still pandemic and kind of shut in, so we're not driving around as much. Is that accurate?
Yes, you got to compare. It's a very seasonal item. So if you look at where we are when I printed this was for last week. I'm guessing this survey period encompassed the holiday week. Look where it was the same week last year. So we're running about typically 8 to 10% below where we were the previous year. This whole time series in here tracks about 8 to 10% below this period right here. And if you think about it, it may be even more of a story, because think about how many people have left the cities. And my sister lives in the Upper West Side of New York. She hadn't been back to Manhattan for more than 12 hours in 9 months. So she's burning more gas than she's, in the last 9 months than she burned in the last 19 years. So you got a lot of people like that. So the trend's probably even worse on a person-for-person basis. All right, let's talk about oil, because this is a supply story, absolutely. Back in the before times, oil was about 100 million barrels per day, world production and consumption. Very elastic pricing. I hope I got that right. You move the needle a little bit. You move the demand a little bit. You move the supply a little bit. You can move the price a lot. High elasticity. I'm supposed to get that right. I hope I got it right. What we've done this year is we took oil down to nothing, right? Remember, it was even negative at one point on the futures contract. We took it down to nothing because you couldn't give it away. Then as the economy reopens and we start burning again, we drive, we use equipment, et cetera, builds back up, we get a second wave of the pandemic, back down, now we're recovering. But why are we getting this spike here and in the last few months? It's not demand driven. The Chinese have been buying oil internationally. They're buying it out of the Middle East for the most part, but it's not demand. This is a supply reduction. Saudis have led OPEC against Russian desires to cut the supply down to the low 90s. So we're now running about 91, 92, maybe 93 million barrels a day for oil in this country. It was either last week or the week before was the first week in 35 years that the United States did not onshore a barrel of oil from Saudi Arabia. Pretty amazing. So is this net positive to the U.S.? Probably. We've got oil at a price where you can drill, where you're not going to overwhelm with shale production, but you're going to keep the banks from having to write down assets of oil drillers, the E&P companies. You're not going to bankrupt North Dakota. It's still a lot of pressure on the high dollar cost production of places like the North Sea or offshore in South America or Canadian oil sands. But for us, this is probably a sweet spot right in here in the low 50s. We can be profitable. We can run our country independent. But keep in mind, this is because of a reduction of supply, not an indication of economic demand. You all know I love soybeans. Same story. Why do soybeans shoot up? Soybeans shot up $13 a bushel. That's a number that is just outrageous. I would have never thought we'd get there. We were, before I walked back here, we were $14.29 a bushel. How did we get here? Total supply issue. Supply problems in this country due to weather issues, supply problems in Argentina, question and demand out of China, but it's really a supply issue. This is the funny one. This is corn. Corn futures, like a rocket, shot up. Corn on this chart was $4.96 a bushel. An hour ago, it was $5.32 a bushel. Again, supply. The supply issue, not a demand issue. Though again, there's Chinese demand, but it's a supply issue. One analyst referred to it as Bitcoin. That I thought was pretty funny. Copper. Same story. Copper earlier today was $3.66 a pound. About the same level we were when I printed this. Copper's on a tear. Demand in China, but it's constrained supply out of South America, of course, due to the pandemic. It's hard to run a copper mine if you don't have the employees there because they're sick. What else is helping commodity prices? Weakness in the dollar. Look at this change in the dollar. It's fallen apart. I mean, just total drop off in the dollar. We're looking at around close to 10% drop off in the dollar since May. And if you want to go back before the pandemic, about 10% decline in the dollar. But look at this. Isn't this curious? Look where the dollar turned. January 6th, my daughter's 21st birthday. Forever, people will remember her birthday for a palace coup. I thought that was the most interesting thing. That's when people came to the dollar. There would be a total panic in America. So my one piece of humor that I forgot with my technology breakdown that I forgot was today is election day in Uganda. They have a celebrity running for president. They had a unilateral shutdown of internet access. They have questions about election improprieties. They have long lines at the polls. And here we are, finally, Uganda has adopted our democratic principles. I thought that was great. So here's one, I want to give you some good news. And again, I don't like surveys right now, but this is real numbers. These are applications for employee identification numbers. Now, I have a theory where some of this could be coming from. But look at the trend up. Don't look at the jagged line, but look at these trends, the moving averages. They're coming up this year. Isn't that weird? Of all years, look at the trend up in employer identification numbers. I'm hoping my theory is wrong, but I have a feeling that you got a lot of people that got risked that decided to go into business for themselves. Some of it might work, might be great, but maybe there's a little glimmer of hope here. There is an indicator that says there are a lot of restaurants that have opened this year. Hard to imagine, maybe they're food trucks, but they're licenses. So I've told you about commodity prices. I told you the Fed is not going to raise rates. Let's look at inflation. So look at this list. These are real numbers going backwards. CPI, the PCE, which the Fed likes, that's the consumer number. You've got the PPI, Producer Price Index. These numbers are all looking backwards, and they're all falling. Red would be falling fast. This shade would be falling slowly. Look at the numbers that are survey numbers and numbers going forward. For some reason, these University of Michigan numbers always seem high. They're in the green zone. They're the go zone. That's where Fed wants to see rates. Fed pays more attention to these PCE numbers, but they want to see rates up in the twos. Break-even rate, that's a market calculation based on inflation securities, inflation-based securities, 5-year, 10-year break-even rates. Dallas Fed trimmed is a complicated number, but that's sort of a backwards-looking number that is based on an adjustment of inflation. That's even been kind of neutral. Here's another interest. This is a forward number. This means a guess, a market-based calculation of where inflation might be 4 or 5 years, starting 5 years from now. So the forward-looking numbers are all high. The backward-looking numbers are all low. If we pulled this chart from a year ago, it'd probably look exactly the same. Expectations for inflation are always always higher than where reality is. It's just the nature of the beast at the moment. Okay. So I don't know how this is going to come across, but I've done this. This is a power ranking for who's the most important people in Washington today. If you don't recognize this guy, this is Senator Joe Manchin from Virginia. I think if you can tell, and this is my opinion, you can tell he got his own color picture. He's a nice looking guy from West Virginia. I believe he is the only statewide elected official in West Virginia from the Democratic Party, and that could be going back for quite a while. Who's number 2? President-elect Joe Biden. As you can tell, he doesn't get as much coverage in this graphic as Mr. Manchin. Number 3, Nancy Pelosi. Number 4 is the team. Mitt, Lisa Murkowski, Susan Collins, Pat Toomey. He's around for 2 more years. I put them together. Who's below them? Bernie. Who's in fine print? If you could see it on your printout, you may have to take your glasses off or put your glasses on. Elizabeth and Alexandria Ocasio-Cortez. They have no power. Alexandria Ocasio-Cortez had so much influence, she couldn't even get on the Energy Committee. Leslie Stahl asked Nancy Pelosi about her on 60 Minutes Sunday night. Nancy Pelosi had a look on her face like someone had just stepped on her cat's tail. There's no power here. This is the power. So what did he do to exert power? He immediately said that $2,000 checks will not get his vote. This was after the Senate races were clinched in Georgia. He is the man in the middle. He said targeted money is going to work, and he'll support that. Without him, it's going to be real hard to get 50 votes in the Senate on anything. So he's the player. He also said he will not support breaking the filibuster. I don't think this is the kind of guy that says something on Monday and votes against it on Tuesday. So this is the lay of the land. Any type of aggressive policy desires from this crowd, they're not going to get an airing. No matter what some of the media likes to say, they don't have much influence. It's here, it's maybe here, it's a lot here, and it's Joe. So, questions, comments on all this stuff I'm throwing at you before we move on to the portfolios, or we can also come back to it if you want, whatever you want, Mr. Schaus. Oh, forgot one thing. Another detail about the supply situation that I didn't get into the slides, but I want to share with you. We've talked in the past about the Baltic Dry Index and the Baltic Dry Index is not doing much. Well, let me give you some numbers on what it costs to ship something from Shanghai, China to Los Angeles, a 40-foot container. It costs about $1,500 to rent one of those things and get a container to Los Angeles a year ago. It now costs $4,000. Why is this? Well, there aren't any containers to go back. There aren't any containers available in China. There's a shortage because they're all sitting here because we're importing and not exporting. So the containers, there's not enough containers to ship out of China. What if you want to ship from China, from Shanghai to Rotterdam? The price went from $1,500 a container to $9,000 a container. That is a supply line disruption. You don't have a chance. So we got a labor disruption because absenteeism at the factory level and at the service delivery level is awful. And we've got unemployment dislocations, and we've got supply dislocations. A friend of mine had a problem with a stove and oven, missing a part. His oven has, I may have even shared this with you all 3 months ago, still hasn't gotten his oven fixed. He's going to have to buy a new oven because he can't get a part shipped from China. That's an economy that's got issues. So back to the original premises, lower for longer, supply lines are the issues. Politics are right here with this guy. And we're going to have to look at our closures and pandemic issues in a backwards way when we hear about it going forward. So, okay, I'm shutting up for the moment. All right, everybody's muted.
Steve, it's Ed. One or two quick
Yes.
ones. Can you hear me? I noticed, I don't follow this every day, as I'm sure you follow these things very intricately. Just noticed the 10-year was above 1% last week, one day.
Yes.
You have any feel for if we'll be by? I mean, you have any feel for? I guess I think, you think we're resigned to the 50 basis points, and we're happy to have that. But you think you'll be calling me with any deals in the next few months?
Actually, I'm more likely to call you in the next few days and suggest we sell a good chunk of what's at Bank of New York and put it into that 50 basis points, as long as you're comfortable that contract is secure and in place for the next 18 months to 2 years. The thing we should point out on the 10-year Treasury, which is a great indicator, every time the government comes to market with an auction, the auction's a winner in the market rallies. In other words, they bring out, we had 58 billion, was that the number? 58 billion 10 years auction this week. They find buyers. The supply brings in buyers. It brings in demand. So I often say supply creates demand because it gives huge buyers a chance to put money to work in positive interest rates. European interest rates are still zero. I think the rate, I don't have it in front of me, but the rate on most European 10-year equivalents is zero or shortly above that. Even Portugal is down to zero on some rates on their term structure. The long end of Treasury market's going to be driven by the stimulus. Joe Biden supposedly is going to announce another $2 trillion in proposals tonight. We'll see if that happens and he can get that through Congress. I doubt he can get that through, but that's what's going to drive it. We've gone from a range of about 80 to 90 on the 10-year to a range of 1 to 115. We were 111 this morning. No, excuse me, we were 109 an hour ago, 2 hours ago. So I don't see that moving up because I think the Fed's really got that under control and they're going to keep buying. But the Treasury's going to keep borrowing and they're pushing their borrowing out. If we don't get a massive stimulus, the interesting thing is we may have a risk of going negative on Treasury bills because we probably have a shortage of Treasury bills right now. Treasury bills are running about 8 basis points. And when we go to the portfolio, you'll see how low the interest rates are on the 2020 proceeds. And then you'll be shocked at what we would have gotten if we hadn't committed all this to munis. But I think the risk, and this is the worst risk of all, and I hate even saying this out loud. If something happens with the vaccines, I don't even want to think of something. But if these vaccines aren't successful, I think we run a risk of seeing that 10-year Treasury go from 109 to about 59. If we're not making progress in solving the problem of this pandemic, I think we're going to have a stock market that goes back to where we were in the summer. I don't think we'll go back to where we were in March. But if that happens, I think we're going to have a buying frenzy in bonds. I have spent a lot of time trying to understand the virus and understand the vaccines. It ain't easy. I wish I remembered who said this, but it was, I think it was a public health policy professional talking about vaccines, said that vaccines and dealing with viruses are like climbing Mount Everest. Once you identify the virus, remember the Chinese lab gave us the genetic code back, I think, in February. Then you create a vaccine, which maybe we had that formula down as early as March, April, May before we started testing it. And you approve the vaccine, which we did a few weeks ago. In the process of climbing Mount Everest, once you get to an approved vaccine, it's the equivalent of having set up a well-organized base camp. So, as I've said in some of the emails that Ed gets, this ain't cornhole. It's not beanbag making vaccines. So my fear is we've got more of a risk of rates in the 10-year or even in the 4 or 5 year area going down quite a bit than we do of them going up quite a bit. I don't think you'll see much of a move either way on 2s or 3s, your portfolio area, because the Fed's got that under lock and key.
Steve, one final from Ed here. What would be, I just noticed the popularity or a story a day or two ago, that municipals or municipalities, I should say, as in Knox County, Knoxville, Memphis, et cetera, doing a lot, not necessarily record numbers, but a lot of selling a lot of bonds, raising a lot of money. What would if you in today's market, the quality we need, what would our yield be on a municipal? Obviously 3 years is all we could go, but I'm just curious.
Right now, if you were buying 3-year munis, you'd be lucky to get 30 basis points, 35 basis points, something like that.
Okay.
That's the most you get. We look at the portfolio. This was the hardest portfolio I've built in a while on the 2020 proceeds, and we have a few items at that yield that took some extra homework. But a taxable muni and a tax exempt are going to be about the same in 3 years. You'd be maxing out at maybe 40 if we were lucky. I mean, there's just not much opportunity right now. If you all issued bonds today, you'd have 30-year around 2%. And it's just unbelievable. If you look at 10-year tax exempts, they're nowhere near 1%. 10-year tax exempts running about, well, I did a trade before I came into the meeting at 75 basis points on an 8-year. So I mean, we're running about 70% of taxable rates, which is really expensive right now for munis. We're about as expensive as we've been in a long time.
Okay, got it. Thank you.
Okay. Any other questions before we go to the portfolios? Okay, I'm going to skip 19 and 19B unless somebody's got a question. We're down to just tag ins. Maybe I can just put it up really quickly. Let's see. Oh, all right, I did that. I mean, I don't know if you can see this. There's $4 million left in 19. It's not worth the time to spend on it. Let's see if this works. Oh, that worked. These were old yields. Where are they? Book yield. This is the grand old days. Average book yield remaining is 2%. This is going to be gone in a few months. Last piece will mature April 15. Same thing on 19B. Just a few left here. Interesting thing on 19B. Same story, 174 left. It'll all be gone in June. Excuse me. We got a couple items here that'll last a little longer, August and November. Interesting one. During the height of the muni crisis back in March, we bought some Tennessee housing bonds. It was a 235 coupon. We bought them at below 99.5 in March. They were supposed to mature in July of 2021. They called them 6 months early, so we ended up making over 3% on that, which is hard to imagine today. Okay, let's see if I do this one. Okay, what is this one? Let's do the Boney portfolio first. Oops. Okay, so this is our Bank of New York portfolio. We're down to 10 million. Ed and I liquidated several of the items, and you had some nice profits. I think we talked about that last time. That was prior to the last meeting. But we were able to make some good earnings on that because you took profits, you had book yields that were above market, and had capital gains, and then turned around and put the money into Truist and earned for the rest of the term an above market rate. You see here your book yield on the remaining portfolio is 186. You got about 150,000 in unrealized capital gains. The overwhelming portion of this portfolio is taxable munis. There has been nothing happened with any of these. Got one government left, Private Export Funding Corp. That'll mature in December. Handful of munis left at big yields. Here's a Georgia bond that'll mature. We got a 267 book yield. The market yields on this stuff is minimal. So I will probably speak to Ed about probably taking profits on these if we can get a takeout yield under 50 basis points and moving the money over to First Bank. I may have missed the timing. Is that contract in place now, or you have a start date?
Start date with First Bank would be February.
Yeah.
February. Okay, so you're still at Truist earning the 1% for the rest of the month?
Yes.
Correct.
Okay,
Correct.
so that's an added bonus. Okay, so Ed, we'll probably talk about that. Any questions on the Bank of New York portfolio? Okay. Okay, so let's go on to something you haven't seen before. These are the 2020 proceeds. Let's see. Okay. Okay, so this is a $62 million portfolio where we put some more money to work since this was printed. We're down to just a couple million in cash in that. I thought there might be a draw in January, but there was not. So we'll get that put to bed. You'll see the book yield on this so far, 32 basis points. Do you all know where that little applause feature is for that icon? Where is that? Where is it? Share sound. Well, if you don't know where it is, you can put your hands together. I mean, this is, to get 32 basis points on this is a minor miracle with a average life of less than a year. A treasury portfolio with an average life of less than a year would be about 8 basis points. So it doesn't sound like much, but this was an accomplishment, if I do say so myself. Again, it's not a lot of money. We're outperforming by 24 basis points, but you know, it is what it is. So it's not impressive, but it's there, and it wasn't easy. So we're investing towards the draw schedule. As you can see, most of the action's been in tax-free munis, and we've just been buying whatever we can find, basically, and buying it on the bid side. The names you'll see in here, pretty recognizable. We don't have much that's interesting. Most of these bonds are going to be AA rated. Some of them are single A when we can find them, but a lot of Texas insured bonds by the permanent school fund, so they're AAA. We've got some AA plus bonds, like, you know, a cheap bond in Illinois that's AA plus on an expensive suburb. This was a good one. We found a mutual fund that didn't want these. It's a shame there wasn't another digit. It was only several hundred. But an airport in a rural area outside of Indianapolis, well, it's guaranteed by the county with a GO. It's hard to beat that. And we got 52 basis points on that. Again, we got a couple of pieces, 200 and 300. I wish it was 3 million and 2 million. But, you know, that's the earnings equivalent, think about it, of 5 times that amount of treasury. So it's a tough market. Piece sizes or whatever we can get. This was a good one. We were able to get Stratford, Connecticut, and you know, got a 39 on that one. But as you glance through it, nothing is too exciting. A lot of AAAs, more AAAs than I would care for, but we take what we can get. 4 million odd in the AA category. I'd love to get more single A. I mean, state of Connecticut, we got 37 basis points average yield on our A-rated bonds. Is it a lot compared to the other ones? No, but it's a benefit. So, and these are the S&P ratings. I think, does it give a graphic? Yeah, here's a graphic. Again, way too much in AAA. I'd love for the portfolio to have more yield to it, but we're just not capable of it. We only have one government agency this go around. We have one Federal Home Loan Mortgage Corp that matures. When was that one? There it is. Just $1 million, 12 basis points. Whoopee. That was probably 4 basis points more than it should have been. Again, we're dealing with the law of small numbers. Nothing's impressive. Nothing's great. I don't like saying it is what it is because it sounds like an excuse, but there's just not much to be done about it in this market. We're as you can see, the number of pieces we had to go to even get invested, and the patience it took to get this much money put to work at the spread we got it. Does it add up? Yeah, you know, a quarter basis point to quarter basis point. Well, if this works out, you know, you got $60-odd million, you make an extra 25 basis points on it over a year. It's actually a lot of money. It'll pay for something. Is it something to be excited about? Absolutely not. It's pretty depressing. So that's where we are on the two portfolios. Questions? I got one thumbs up. I got a lot of disgruntled faces. Nothing exciting. Oh, there's a smile out of the mayor. Okay. Yeah, it's not much we can do about it. And this isn't going to change. It's not going to change. The good part is when you're borrowing extremely cheap. The bad part is not much can be done with it.
Does anyone have any questions for Mr. Rosen? All right, Stephen, is there anything else?
No, I'm very happy that we had a meeting without using the T word, and I made it all the way through it. No particular reason to look backward, but I will emphasize the conversations are going to be different, and there's it's a different environment. But hopefully we can keep the economy going. Stimulus will make a big deal. We need that shot in the arm. Oh, I do want to leave you with I'll leave you with 4 other things that are pretty amazing that just popped up today. And I mean, listen to these numbers. Government benefits now account for nearly 20% of total personal income. 1 in 4 households have not been able to meet their monthly bills since March. 1 in 15 homeowners are in some sort of loan forbearance relief plan. 75% of the government stimulus went to pay down debt or into savings. 1 in 3 households dipped into savings or retirement accounts over the past year, and 1 in 6 has borrowed from a family or friend to cover bills. Fortunately, in Knox County, we haven't had as much pressures, though state unemployment claims were the highest they've been this reporting week. We're at 21,000. I'm afraid we're going to see some tougher times. Our finances in the county have been good. The city's been strong. Our unemployment hasn't been bad. But we got a tough road going forward. And the sooner we get everybody inoculated and the economy going again, the better. But it's going to be a tough road. Postscript.
All right, now, before I make my way up to the top of the city county building to jump off, does anyone else have anything today?
That would be reactive, not proactive.
Very true. Is there any other discussion?
Proactive.
Are there any other discussion items or any new business or anything that we need to go over? Okay. Thank you, Mr. Rosen. And I guess at this point then, do I hear a motion to adjourn?
So moved.
All right. Thank you. I'll see you next time. Thanks again, Stephen.
Thank you all. Have a good
Thank
day.
you all.
Thank you.
Sorry for the technology.
That's all right. Thank you.
Thank you.